class, we're going to be discussing Fibonacci retracements. And Fibonacci retracements are ratios used to identify potential reversal levels. These ratios are found in the Fibonacci sequence. The most popular Fibonacci retracements are at the 61.8 level and the 38.2. Now, note the 38.2 is often rounded off the 38 and the 61.8 to 62 because Fibonacci levels are not exactly precise. They are alert zones or levels that alert you to something. So after an advance, chartists apply Fibonacci ratios to define retracement levels and forecast the extent of a correction or a pullback. Fibonacci retracements can also be applied after a decline to do the exact same thing. These retracements can be combined with other indicators and price patterns to create an overall strategy. Now, before you can start using Fibonacci, whether you're going to use them later as just retracements, or you're going to master extensions, or you're going to learn Fibonacci arches, you have to understand where these numbers come from. Okay. Now, the sequence, it was developed by a mathematician back in Italy, a lot of years ago. And it's not a complicated process. Basically, the Fibonacci sequence is derived from taking a 0, starting out with 0, and then adding it to a 1. Then you add the prior two digits together, and it will give you the next level. So 0 and 1 gave us 1. 1 and 1 gave us 2. 1 and 2 give us 3. 2 and 3 give us 5. And so on and so forth up into infinity. But this is where these Fibonacci numbers come from, or the Fibonacci sequence. So it's simply a mathematical calculation of just adding the prior number to two previous numbers together to derive the new number. You start out with 0. Okay. 0 plus 1 gives you 1. 1 plus 2 gives you 3, and so on. That's it, but it's always the same. You don't start out anywhere else. You don't start randomly in the middle. This is way, and it's calculated all the way up. Now, there are lots of mathematical involved calculations you can do, and the sequence extends into infinity and contains many unique mathematical properties. But we don't need to know all that. Now, how does this sequence turn into a ratio? Because as we said earlier, we use 38.2, or the two predominant ones for trading are 38.2 and 61.8. But there's also a 23.6, there's a 71.6, and it goes on and on and on. But these sequences, as they get farther and farther out, don't relate to our actual trading. So anything between 0 and 100 is what we look at. Now, how do we determine these? Okay. So where did we start out? We started out with 1 and added it to 2 and got a 3. We added the 2 and the 3 together, we got a 5, the 3 and the 5 together and got an 8, and so on, just like this sequence. So we've got that down pat. Now, if we were to take the number divided by the previous number, okay, we have the sequence laid out. So if we were to take this number right here and divide it by that number, it would always give us something in the area of 1.618. It's, the division comes out and is not exactly the number because we're all the way over in 4 decimal points, but it is the always approximation is to 1.618. If we were to divide the next highest level number, so in other words, let me just clean this up for you. If we were to take 13 and 21, where do we get the 13 sequence? We had 5 plus 8 gave us 13. The 13 plus 8 gave us 21. But if we were to take the 21, instead of dividing it by the 13, which would have given us 161.8, we go over 2 digits and we divide the 21 by the 8, it's going to give us 0.618, which is approximately always, no matter how you divide it out, is 0.618. And this comes to the 618 retracement level. If we were to go over a third digit and divide it out, this would give us a 38.2, which gives us the third level of the Fibonacci sequence. Now, if we were to take and just look at the mathematical, mathematical magic, shall we say, of the Fibonacci's, if we were to simply start, now we just did all these divisions, but if we took 1 and subtracted the 61.8, we would have gotten 38.2 anyway. So this gives us 38.2, and 61.8 actually gives us the whole. If we were to go back and then move it one more decimal point, or one more digit, not decimal point, and we were to go back to the same sequence here, but we were to take the 21 and not go to 13 or the 8, but go back 3 steps, divide it by 5, or the 5 by the 21, we would get 0.2360, which is also a very popular Fibonacci number, a retracement level, which is something we consider a very shallow level. Because now that you have these numbers, you have to understand what they all mean to us in trading. But we have our Fibonacci levels, and they come from these numbers, or our Fibonacci ratios. Now, a lot of people say to me, I see something missing. You missed something, Barry. And I say, what? And they like to tell me I missed 50. They tell me they know Fibonacci's, and it's 38.2, 50, and 61.8. Well, we'll get to that in a second. But if you remember right, the first number we came up with was 1618. 1618 refers to the golden ratio or the golden mean, and it's sometimes called phi. The inverse of 1618 is 0.618. Now, these ratios can be found all throughout nature, even though we just did this little calculation, okay, and we didn't apply it to the universe, and we didn't look at any big calculations, and we didn't use big computers, and we didn't go out and look at physics and biology. Guess what? The proportion of 61.8 to 1 is the mathematical basis of the shape of playing cards, of the Parthenon, of sunflowers, on the little round scrolls on the back of a snail shell, Greek vases, and also the spiral of the galaxy. This ratio is also the basic ratio between your ears, nose, and mouth. The Greeks based much of their art and their architecture upon this proportion, and they called it the golden mean. So what we've done is when we've applied it, those same numbers that were applied throughout history, and we would apply them in the financial markets, we would find that an asset will often pull back or retrace a percentage of its previous move. These Fibonacci retracements often occur at 3 levels, 38.2, 50, and 61.8. But actually, the 50% level really does not have anything to do with Fibonacci. Absolutely nothing. It's just in modern day and in the financial markets, because a 50% retracement is so common that it's just been added into, for the financial markets, into the retracement or into the Fibonacci scale. Now, what we mean is when we talk about a retracement is when an asset has made a move. We're not talking about just a 2-second move. When an asset has trended up, okay, and that trend has finished and ended, and we either move into sideways congestion or downtrend, this asset will have a tendency to retrace down 23.6, 38.2, 50%, or 61.8 of this move. Now, and at some point, in that retracement, it will reverse and move back into its movement. So in other words, if an asset had pushed up and now moved into a downward move, it could retreat to the 38.2 level. It could retreat to the 50% level, or it could retreat as far as the 61.8 level. So these are three levels that we're looking at. But you're saying, well, what is this level? How does it apply to me? Well, imagine if gold or Bitcoin, say hypothetically, had moved up $100 in this move. It would retrace about 38.2. So say it started out as 0 and moved to 100. When it went into its retracement phase, it would come down to 38.2 of the prior move. So 38.2% of the prior move, which was a 10-point move, would be about, okay, well, 382, but it would take us down to about 62%. So 62, not percent, 62. So if the asset had moved from 0 to 100, if we made a retrace, it would possibly come down to 68.2 or 66, say $66, which would have been 38.2 of the original retracement. Now, it doesn't have to stop there, but it has a common thread that it most likely, there's a good chance it will. So that becomes a number. But if it doesn't, we would expect it to come down to the 50% level, which is 0 to 10 move would have been down to the 5 and then bounce back. If it doesn't, we would then set another level that we would look at it at the 61.8, because as an asset is moving up or down, it's always making retracements because an asset doesn't move in a straight direction. We want to know, okay, number one, where to panic. Okay, if we were in the market here, okay, we don't want to sell out of the market just because it's doing its up and down, up and down, up and down. But we want to know, okay, at what level do we have to watch it? Or if we got if we sat on the sidelines because the price had gotten too high, we want to say, where would we want to enter the market? So we would see first at a 38.2 retracement. When it hit that and it bounced off, we might say we want to enter the market now, or we would wait for the 50% level. So they become levels of support and resistance. So the picture shows a graphical representation of the reversal points for a stock in an uptrend. The pattern is reversed for stocks or assets in a downtrend. After an asset moves up to the upside, it can then retrace a part of that move, which is the B, before moving back up in the desired direction. These retracements or pullbacks are what you as a swing trader want to watch for when initiating long or short positions. Once an asset begins to pull back or retrace, then you want to plot these retracements on a chart to look for signs of reversal. So drawing these on a chart are relatively simple because whether you're using the charts on ETX or using TradingView or anywhere else you go, under indicators, it's going to give you the Fibonacci retracement tool. And you simply now, the key to Fibonacci is finding the previous move. Okay, you're looking at a previous either uptrend or downtrend. So in order to find these Fibonacci retracement levels, you have to find the recent significant swing high and swing low. Then for a downtrend, click on the swing high and drag the cursor to the most recent swing low. For uptrend, do the opposite. Now, we're not talking about what it's trading in now. We're talking about the previous trend that is completed. So let's go look at a live chart. Okay. Now, identifying the previous trend is what is key, and identifying the significant swing high and swing low. So we're looking at gold, and gold is just completed a downtrend. We can see that downtrend is definitely over, and it moved into an uptrend. Now we decide what time frames we want to do this. Okay. Now, you could also define the most recent uptrend and the swing high here or the swing high here, because now you can say it's moved into a downtrend. You can use either one of these. You have to decide. Because we could say that we're not sure this uptrend is ended yet, because it could be just in a momentary pullback. But if we wanted to identify this swing high and this swing low, this swing high low and this swing high, and when we say the significant one, you see this one? This one's not a significant one. This one, something happened in the market. It was a rare thing. So we would say that this is a significant swing low. This is where the asset reversed. And we do this by looking at changes in candlesticks or changes in other indicators that will help us identify, or a pattern within the candlesticks will help us identify that significant swing low. So once we've identified the levels, we want to go over to our tool and find our Fibonacci tool. We're going to come down to Fib retracements. And so since this is an uptrend, we've located the swing low and we're going to pull it higher. Okay. So now that we've placed our grid on there, it's done the calculations for us also. The 38.2 retracement is here. And look at how strategic that was at this level. The 50% level is here. Now, I'm just trying to get it to put these on darker so you can see them. So these are the levels that we would be looking at. And we can see, like I said, that how important this 38.2 level was, and see how the asset moved down to the 38.2 level and bounced off of it. Now, if it didn't stop there, we would have looked at it to go to the 50 level, which would have been right here. And you can see the asset price is already calculated for you. We can see, again, here's another chart for Ripple, where this has been applied. We have the Fibonacci levels on here. Here you can see another level of the Fib levels dropped on here. And you can see as the pound was moving down, and you can see each one of these levels. Now you see 76.4 didn't hold, but look at what happened at the 50% level, which was right here. So we see all the moves, and it's created a level of support and resistance. Okay, and we can see also here the support and resistance levels with the Fib. So we see a clear uptrend here. You can see I put the red line on here for the downtrend. So this price right here would have been our significant high. This would have been our significant low. Okay, because this downtrend was over, and now we're starting to move into a shallow but a nice uptrend. We moved into some. So we would again go over to our Fibonacci tool. I'm sorry, let me get my markers off of here. And we would simply put those on our charts. And then we can extend them out in the future. And just because one set of fibs or the uptrend or the downtrend ended doesn't mean that those prior fib levels do not become invalid. You can have overlapping fib levels from each trend line, because all they're doing is giving you levels of support and resistance that could be significant in the current or the prior price move. So we can see that Our resistance level is set here, which was the 38.2 level of this previous trend. Our 50% level was about here. Actually, let me just pull it forward here. For some reason, I didn't want to extend forward. Okay, so we can see those levels. We can see the 61.8, and as that move was on there, look at how crucial the 61.8 level was here. Okay. You can see how crucial the 50% level was here, and the 38.2. As it was moving into that uptrend, look what happened. It came up to that support resistance level and bounced right off of it. It then fell down to the 50% level. And now we're looking at it, projecting it to continue falling lower. But all those numbers held true for us in the price movement. So let's go back to my PowerPoint. Okay, so remember, when you have completed a downtrend, you pull your click, you take your click and click on the swing high and drag it down to the swing low. When you finish the uptrend and you're pulling in an uptrend, you click on the swing low and drag it up to the high. It's important not to get these backwards. So in other words, we isolated our swing low here, and because this was the end of our uptrend, we've isolated our swing high here, and then we would pull our Fibonacci tool here because this is our 100%. So when it's moving down, okay, see it's broke the 23.6 level, and we would expect it to come 38.2, 50, 61.8. And the tool calculates for the exact price levels, so you're not sitting there calculating or having to calculate what exactly price it is. On a downtrend, you do the exact opposite. Identify the swing high and then locate the swing low and draw your tool forward. And I'm going to show a quick video here, and my friend Dave Jones is going to explain this a little bit better and show you some examples. And then we'll discuss this a little bit more. All right, ladies and gentlemen, so that should give you a little clearer view of the retracement levels and how to use them. Now, you have to remember the retracement levels are alert zones. They alert traders and investors of a potential trend reversal, a resistance area, or support level. Retracements are based on the prior move. A bounce is expected to retrace a portion of the prior decline. So what it means is, again, in a normal movement, in an uptrend, it's not telling you that uptrend is over. In a normal uptrend, a price should push up, it should ease down, push up, ease down, push up. As you're entering that ease, you want to know how far it's going to ease down. So like here, we were in a strong uptrend. Price eased down, broke the 23.6, came to 38.2, and then returned to its uptrend at this point. Now, when you see it bounce off the 50 or the 38.2, you need something. You can't just use those and say, I'm going to trade that. You need to have some type of determination that, yes, we have now moved back into an uptrend. Candlesticks will help you. A bullish engulfing or a bearish engulfing will help you. There are other tools that will help you. Using regular pivot point support and resistance levels will help you. But you have to have something that tells you, yes, that pullback is over and we've moved back into that uptrend so that you can enter the market. So once pullback starts, chartists can identify specific Fibonacci retracement levels for monitoring and alert. Okay, as the correction approaches these retracements, chartists should become more alert of a potential bullish reversal. So in here we can see the 38.2. Okay, in here we can see for Home Depot stock here, we can see a beautiful retracement. Okay, so here was our prior uptrend. We moved into the downtrend, and look at that, we came right down or to the retracement, okay, at that 38.2. But at this point, we're not sure whether we're getting to a retracement or a reversal. Okay, so you're not going to be buying or selling at this level. Now, 38.2, you might be watching very closely because you're looking for some type of idea whether you want to enter the market, or if you're in the market, do you want to get out? But you're still not going to panic yet. At 50%, look at that. We came right down to 50%, touched 50% with our low, and turned around and bounced off of it and continued on its merry way. So it alerted you and kept you aware of what was happening in the markets and kept you from panicking and selling too soon, because you don't ever want to sell too soon. Yes, it's possible. You know, me, I'm a conservative trader. So you know what? When I see it falling down to 38.2, it's not that I panic. I just take my profit. I got a nice profit, and I take my profit and leave the markets, because you can always re-enter the market. The fact is, though, when you sell and buy, you're paying the spreads twice on two sides, and there's no guarantee at what point you're going to realize to get back in, and you're basically losing profit. But on the other hand, you don't want to lose and turn it into a risk and lose your money also. So keep in mind that these retracement levels are not hard reversal points. Instead, they serve as alert zones for a potential reversal. It is at this point that traders should employ other aspects of technical analysis to identify or confirm reversals. These may include candlesticks, price patterns, momentum oscillators, and moving averages. So remember, the common retracement, the Fibonacci tool puts the most common: 23.6, 38.2, 50, and 61.8. Remembering, 23.6 is a very shallow retracement, and 50% is really not a Fibonacci, but it's just, assets tend to retrace at the 50. And 50% actually comes from Dow theory. When Charles Dow developed his theories back in the early 1900s, and he came up with the idea of trends and how to trade, he observed that 50% was where an asset would turn around and move back up. Now, based on depth, we consider the 23.6 retracement relatively shallow, and it's very hard to trade from that because it comes and goes so fast. But shallow retracements occur, but catching these require a closer watch and a quicker trigger finger. Moderate retracements are the 38.2 and the 50. 61.8 is a very deep retracement and very worrisome. So if you've been paying attention in class, you know by now that you can combine the Fibonacci retracement tool with support and resistance levels and trend lines to create simple but super awesome trading strategies. Now in the handout I gave you, I've given you some real basic strategies and some starting points. When combining the Fibonacci retracement tool with candlestick patterns, we are actually looking for exhaustive candlesticks. If you can tell when buying or selling pressure is exhausted, it can give you a clue of when price may continue. And a secret weapon, volume, 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 volume. You can see what other traders are doing and what they think of those levels by monitoring the volume. And volume will help you see whether they are moving, if it's, traders believe it's going to continue back up or they're selling out of the market. Volume is a very important tool that will help you, or candlesticks. Now we talked about in the video how to place stops, and using these, and this has to be something based on your own risk management and your own money management skills. But if you're planning to enter at the 38.2 fib level, then you would want to place your stop slightly beyond the 50% level. If you felt that the 50% level would hold, then you might want to put your stop at 61.8. But that's a little bit far. But again, you have to calculate based on the market volatility and your risk management stop loss reward ratio. Now, if you want to be a little safer, another way to set your stop would be to place them past the recent swing high or swing low. This type of stop placement gives your trade more room to breathe and gives you a better chance for the market to move in your favor of the trade. But again, risk management is what it all comes down to. The truth is, just like in combining Fibonacci tools with support and resistance trend lines and candlesticks to find better entry, it would be best to use your knowledge of these tools to analyze the most current environment to help you pick a good stop loss point. As much as possible, you shouldn't rely solely on Fibonacci levels as support and resistance points as the basis for your stop placement. Remember, stop loss placement isn't a sure thing either. So, Fibonacci retracements are often used to identify the end of a correction or a counter trend bounce. Corrections and counter trend bounces often retrace a portion of the prior move. While the short 23.6 retracements do occur, the most popular are between 38.2 and 61.8 and the possibility of 50. This zone may seem big, but it is just a reversal alert zone. Other technical signals are needed to confirm a reversal. So on that note, I hope together with the videos, with the little bit that I showed you, the explanation, the handout I gave, you have some general understanding of fib levels, and you'll start combining them into your trading. Now on the new ETX Trader Pro platform, we've moved the indicators across the top. So just click across the top of the charts and you can see the Fibonacci's, and just click on it and it'll drop it on your charts for you. And remember, you can always use our demo account and try out your Fibonacci retracements in the demo, try out some demo trading using fib levels and combine them in strategies, see which ones work best for you. And then once you've got it all down pat, you can move it into your real money trading accounts. So thank you very much. And remember, always use your own judgment, always use your own understanding, and always be aware of the risks and using risk management and money management skills. Thank you very much and have a great night now. Bye.